Okay. Good afternoon, everybody. I'd like to welcome everyone to the Kentucky County Employee Retirement System regular meeting for the month of June. Sherry, excuse me, Eric, uh, can you read our opening statements for us, sir?
Of course. This is a regular meeting of the County Employees Retirement System Board of Trustees. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. The connection cannot be reestablished within 30 minutes. The meeting will be adjourned and rescheduled to a later date.
Okay. Thank you, Eric. Sherry, could you take the roll, please?
Yes, sir. Mr. Cheatham?
Here.
Dr. Carver?
Here.
Mr. Foster?
I'm here.
Mr. Fulkerson?
Here.
Dr. Hackbart?
Here.
Mr. McGraw? Oh, he's coming back on. I'll come back to him. Mr. O'Mara?
Here.
Mr. Webb?
Here.
And Mr. McGraw?
Here.
Thank you.
Everyone being accounted for and present, we'll go ahead and move forward. Sherry, I believe we had a public comment that needs to be read.
Yes, sir. We received one public comment for this meeting, and I will read as follows. This is from a Timothy Douglas Banta, and he writes as follows. I am a member of CERS Hazardous and retired in 2016 with 25 years service. While the debate was going on about the 13th check for CERS, I contacted my representative with the 88th district. She responded with a postcard saying CERS was not in her jurisdiction. My understanding is in order for the board to vote, they need legislative approval due to funding levels. I am also a member of KPR, and several other lawmakers have said the board did not need their approval. As a CERS retiree, I would like for the board to address this in the meeting. I'm aware it's too late for this session, but please address this. Unfortunately, we have lawmakers that like to pass the blame. I'm not asking for the board's opinion on the 13th check, just what legally needs to be done for a vote to be held. Thank you for your time.
Okay.
Thank you.
I appreciate the comment. Eric, I think it'd probably be appropriate if you wanted to put together something that outlines what the process would have to be, and we'll be happy to present that at the next meeting and post it on our portion of the website. I think that would be a good clarification for everybody involved.
Of course.
Okay. All right. With that, we have two sets of minutes that were included in your packet. The first for the meeting of April the 15th. Has everyone had an opportunity to review those? And if so, are there any changes, additions, or deletions that need to be made? Hearing none, I'll entertain a motion to accept the minutes of April 15th as presented.
So moved. Second.
Thank you, Tommy. Any discussion? All in favor signify by saying aye.
Aye.
All opposed? Ayes have it, minutes passed as presented. The second set of minutes that you had in your packet were from the May 11th meeting. Are there any changes, additions, or deletions that need to be made here? Hearing none, I'll entertain a motion to accept those minutes as presented as well.
So moved. Second.
Got a motion and a second. Thank you. Any discussion? All in favor signify by saying aye.
Aye.
All opposed? Ayes have it. minutes of the May 11th meeting pass as presented. I'm going to be pretty short and sweet. It's been a pretty active period of time, even though the legislature is now adjourned. I want to take a minute to thank both Bill and Ryan. We've been having some ongoing discussions with Ryan and his leadership team over the last month and a half, and I think over the next little bit you'll get an opportunity to see some of the work product that will come out from that as well. But with that, I'll reserve any other issues to later on when we get into the CEO's report. With that, I'm going to move on to the item 7 on the agenda, the actuarial committee. Mike, I believe that puts a ball in your court, sir.
Yes, sir. The actuarial committee has met and reviewed actuarial assumptions, data that were provided by GRS, and I would like to pitch this over to them to give the complete board an update on that, and then we'll consider a motion later on.
Okay, Danny, I believe that.
All right, I was going to actually defer to Janie if Janie's available. Not hearing her, so I'll let her jump in if she's able. But so this is it's an annual process that we go through as an exercise, confirmation of or possible adjustment to the principal economic assumptions. So the three that are noted here below are the price inflation, investment return, and payroll growth. We're not recommending any assumption changes from last year to this year, so continued use of these three. Keep in mind the price inflation, while it may make the most headlines recently, it's not actually used directly in the calculation of the liabilities and such, namely because you don't provide a COLA and you don't provide a COLA tied to CPI. So there's no benefits that actually adjust or change with actual historical change in CPI. The investment return is probably the most important assumption. And then on the payroll growth, this only affects how you project out the future membership payroll for amortizing down the unfunded liability. So we can go through in more detail if anybody has questions. If not, I'll open it to the board for any questions they may have.
The only thing, Danny, that I'd like you to address, and I ask this question every time because I know our trustees realize it, but for anybody that views these meetings, I think it's well worth them understanding that these assumptions and eventually the contribution amounts that we set based on those, how and why they are designed to reach full funding when they do.
Yeah, absolutely. So the board has control over the assumptions, the economic and demographic assumptions. The one part of the funding, which includes this incorporates into your funding policy about how the unfunded liabilities that be amortized down or paid down. The one item that this board doesn't have control, and it's in state statute that the legislators have historically kept control over, is the funding period, or this funding base and unfunded, how's it be parsed down and financed. So it was over a closed 30-year period, as in 2019. I believe we're down to 25 years this year. And on the original base, and any new gains or losses that occur there's a new tranche or base that is picked up and amortized over a different or separate 20-year funding period. So when you look in our report, we keep track of the gains and losses that occur each year and that are different than assumed, whether it be investments or liability. and that's financed over a separate 20-year period that pays down. So the thing to keep in mind of is the very large base established in 2019 or last established, and that is the one that sets your, I believe it's fund to 2049 is kind of the marketing or branding approach of it. That is when the CERS plan, at least that portion of the base will be completely financed, and you should be close to fully funded, because you would presumably, we would hope that any new bases will be credits that may offset, an outstanding amount, and they'll be much smaller than this current existing base. So, Mr. Shima, if you had other questions, that hopefully that addressed your question and the fundamentals of the board in paying down the unfunded liability and kind of how the mechanics work. But happy to further explain if I need to.
I think you hit it. I just, a lot of times we get questions as to, well, why can't you, pay it down quicker,
Hmm.
or, things of that nature. And, I think it's always worthwhile to make sure people understand that we basically have what's amounts to what, about a 23-year mortgage, and that's, when we're set up to have this unfunded liability paid off.
Yep.
The only variable, obviously, is the contribution rates, which are a large part determined by the assumptions we make on return and what the actual performance is. But we're committed to that 2049 funding deadline.
Yep.
That's what the legislature has put forward, and that's the number we're committed to targeting.
That is correct.
Okay. Anybody have other questions for Danny? Janie, I don't know whether you've got your mic working. Is there anything you wanted to add?
No, the committee met and reviewed the recommendations that you've heard today and asked lots of questions. And in view of that, Mr. Chairman, I make a motion we accept the recommendation of GRS concerning the actuarial evaluation going forward.
Okay. Got a motion by Mike. Is there a second?
Second.
Okay, thank you, JT. I've got a motion and a second. Any discussion, questions? Hearing none. All in favor of accepting the actuarial evaluation and their assumptions as presented, signify by saying aye.
Aye.
All opposed? Ayes have it. Mike, I appreciate your committee's work, and we'll move forward from here, I guess. The Finance Committee report, Bill O'Mara.
Thank you, Mr. Chair. The CERS Finance Committee quarterly meeting was held on May 18th, 2026. We're going to bring two items to the board for ratification. The first is the hybrid percentage allocation, and I'll ask Mike Lamb to make a abbreviated presentation on that to the committee, to the board, please.
Yeah, so on page 26 is the memo that was presented to the Finance Committee. Basically, this is taking the KPPA approved hybrid percentage for CERS, that is 64.38%, and allocating that among the two CERS pension plans, the non-hazardous plan and the hazardous plan, and that's typically been done by head count. And so that allocation would be out of the total 100% hybrid amount, 59.17% of admin expenses would be charged to the non-hazardous plan, and 5.21% of admin expenses would be charged to the hazardous plan, bringing that total to the CERS amount of 64.38%. And then there's a chart in there showing what last year's numbers were, just for comparison.
We have any questions for Mike? Hearing none, the committee recommends to the Board of Trustees for ratification of the 59.17% non-hazardous allocation and the 5.21% hazardous allocation for the 2027 fiscal year.
Okay. That was a motion, correct, Bill?
Yes, sir.
Do I have a second?
Second.
Second by Dr. Carver. Any questions or discussion? Hearing none, all in favor signify by saying aye.
Aye.
All opposed? Ayes have it. The 2027 hybrid percentage allocation is adopted as presented. I'd like to reiterate for anybody that's listening to these meetings, you know, a lot of times the discussion we have in the full board meeting may be a little bit abbreviated versus what you might be able to listen to in the actual committee meetings. I encourage everybody to even the other trustees that may not be sitting on those committees to tune into the Facebook or YouTube page, wherever you can find the full recording of those meetings and listen in, because those conversations tend to be very, very robust and sometimes last a little bit longer than Dr. Hackbert's 2-hour limit. So I just wanted to point that out to everybody. Bill, your second item?
Well, while we have Mr. Lamb here, he can present the update on the quarterly financial recap, and then we can go to our second item on hazardous duty request. So, Mike, do you want to finish?
Thanks, Mr. Romero. Yes, starting at the page 21, and we do go through these financial statements in the Finance Committee pretty detailed. I try to summarize them here as well, but at the bottom of that page, you can see the total fiduciary net position for the C system is at 20.9 billion through the third quarter. That's up 9.86% or 1.8 billion from the 19 billion at prior year's March 31. The middle of that same page, you can see the total investments at fair value have increased overall by 10.75% or nearly $2 billion. The largest increase is in public equities, which is up 15.27% or 1.3 billion across all plans. Near the bottom of page 29, you can see $754 million, which represents the change, in this case, an increase in the fiduciary net position through the third quarter of this fiscal year. The same period in the prior fiscal year was an increase of $565 million. So this year is up 33.49% higher, or it's $189 million more. This higher amount of $189 million between current year and prior year is driven by the overall net investment income being up 21.13% or $189 million more. I can get into a little bit more details on the contribution reports on page 30. Through the third quarter, both the CERS pension plans received $904.5 million in both member and employer contributions, and that is $21.1 million more than what was received during Q3 of 2025. So I've just added up all of those numbers for 26 for both plans and member and employer pay credit and given you those numbers in total. The net investment income for the two pension plans was $250.4 million and is $21.4 million or 9.34% higher than the prior year amount of $229 million. Both pension plans paid out $1.1 billion in benefits, refunds, and admin expenses versus $1.07 billion during the same 3 quarters of the prior year, and that's $36.3 million more, or 3.38% higher. The results show that on that light yellow line, the net contributions, that the CERS non-hazardous pension plan had a negative net contribution of $6.2 million, and the CERS hazardous pension plan had a positive net contribution of $50.3 million. However, when you remove the net investment income of 182.7 and 67.7 million respectively from those two plans, the CERS non-hazardous plan has a negative 188.9 million negative cash flow, while the CERS hazardous plan has a negative $17.4 million cash flow through the third quarter. The next page is the insurance plans, and we'll just start with the net contribution line item there, where it shows that it's 6.1 million positive for the CERS non-hazardous insurance plan, and the hazardous insurance plan has a negative 36.1 million net contribution amount through Q3. If you remove the net investment income of 65.9 million and 29.6 million respectively, then you see that there is a negative 59.8 million and a negative $65.7 million of cash flow respectively for those two plans. Also, we went through the past due invoices report as of March 31. These are the top 10 employers. We had quite a bit of discussion on that top 10, as well as the changes between this quarter and last quarter. We talked a little bit about why those reasons were. I was able to look at past due accounts receivable as of May 15, right before that finance committee meeting, and the top 10 employers changed as follows during that time. So Elliott County didn't change, KRRJ had no change, Anderson County was a bit higher, Metcalf Regional Health Center was much lower, the Elkhorn had no change, Frankfort had all been paid as of 5/15, Hopkinsville had no change, Jefferson County Board of Education had no change as of 5/15, and Davies had all been paid, and Knott County had all been paid. So I was asked about some other employers starting on page 33 of this packet. And so basically this shows during that finance committee meeting, we had a pretty good discussion about past due invoices versus open invoices and what else could be reported on. We didn't really come to a conclusion, but I wanted to provide additional information. So basically what I've done in this chart is I've put the balance as of March 31, 2026 of the open invoices for every employer in the C system and the past due invoices, as well as those same balances as of May 31, 2026, and the changes since March. And so this is sorted by past due amounts as of May 31. So Elliott County Ambulance Service is 1.283 million open, 1.283 million past due, and then it goes down from there, and then it has the changes. I highlighted some things in yellow. Some of those entities were specifically talked about in the Finance Committee meeting, as well as some of them had significant changes between March 31 and May 31 in their open amount as well as their past due amount. And so I've just kind of highlighted them for ease of use. I think 2 or 3 pages down you get to the city of Carlisle, which was talked about specifically. It wasn't on the March 31 past due report because nothing was past due, but as of May 31 there's some things that are past due related to the city of Carlisle. And again, I do this on a quarterly basis for the boards. Me and my team talk about these employers on a monthly basis, and we put together a packet for the CEOs to talk about as well. So be in preparation for the board meetings. But that's just more information, more detail showing all 1,200 CERS employers and the various open and past due amounts. The next 2 pages show the normal penalty invoice report that is presented each quarter. There were 7 new penalty invoices that were waived or canceled. There were 6 that were created, and there were 47 that were actually paid during the quarter of January, February, and March. And before I go to the next piece, which is, I believe, the admin costs, any questions on the financials or the accounts receivable for CERS?
Mike, I just wanted to thank you for your responsiveness and detail in presenting that information. So I appreciate it.
Yep, no problem. I think Mr. Webb has his
Mr.
hand
Webb
raised.
has his, yes.
Yeah, thank you. Want to echo that from Mr. O'Mara. Thank you for putting those out there. I think one of the distinctions we're trying to understand as the board is I understand that when you are pulling your overdue payers, you're querying a system based on an invoice date, and the invoice date may be very different than when the actual obligation occurred in an accrual sense, if you will. So I guess maybe the best way to ask my question is to give a specific example. If I'm running an entity today that's a member of CERS, and you discover today that I have a payment that is overdue that's 6 months old, at what point does that show up on this report?
Yeah, so there's things we could talk about that. So usually that happens when we're reviewing an employer or we get notification at retirement that someone wasn't granted the correct service or the correct retirement contribution, right? So when we learn about that, it could be 6 months old, it could be 6 years old, and we learn about that, we calculate what that payment amount should have been, and then we invoice the employer for that amount. The employer typically has 30 days to pay that. So it would not show up on an employer invoice report until we invoice it. So we have to know about it, we have to calculate it, and then we have to notify the employer, and then it wouldn't be past due for at least 30 days. One thing I do want to mention is that the system, granted, didn't have that money in its account for 6 months, but it also didn't have a liability because we're counting that member as, just take for example, as maybe that member only has 5 years of service, but they're missing 2 years of service. So when GRS looks at that member and they do the actuarial evaluation, they're counting that member as a 5-year service member. They're doing their valuation calculations. We're creating a liability for that member as of a 5-year service. Once we know that they should have 7 years of service and we need to bill 2 years of service, we bill that, we try to collect it, we try to make the system whole as well as the member whole. That's not the best case scenario. Of course, we want that member to be made whole on day one. We want that member to have his contributions and the employer related contributions in the system as early as possible. But yeah, we wouldn't have it on our accounts receivable until we know about it, until we calculate it, until we invoice it.
Very good. That's helpful. Thank you. Thank you for the clarification, and thank you for you and your team to continue unraveling this. It's very helpful.
Ike,
Yes, sir.
I'm a little bit reluctant to ask this question because we've already talked about it, but it may be worth the full board understanding what you and I and Ryan and Bill talked about back a few weeks ago. Taking that same example that you gave, and instead of talking about 5 year service versus 7 year service, whatever, that individual is knocking on the door saying, I want to sign up for my retirement benefit. And in that process, we determine there's whatever it is, 6 months worth of time, 2 years worth of time, whatever it is, that is missing off that service record. Can you give, just a high level view of how that is calculated and billed not only to the employer, but also to the employee?
Yeah, so in that case, that's called the omitted service. And Aaron, if I misspeak, please step in and correct me. But so we've determined that employee who's ready to retire has omitted service. They're missing 2 years, 5 years, 7 years, whatever it is. We would need to collect the contributions related to that omitted service from both the employer and the employee. And so the employer is obligated to pay that, period. Because they're a participating member of the system and they need to pay those contributions. And once that employer pays, if the employee pays, then they get that added service credit and it gets them their additional years of service related to their retirement calculation. The employee can choose not to pay, is my understanding. Maybe they've got a calculation that's good enough for them to retire on. But in most cases, the employee will find a way to pay that and get their full years of contribution. But we need both the employer and the employee payment related to those omitted years in order to recalculate that retirement for the full years of service that that employee worked.
The only thing I would add, Mike, to that is even if the employee retires and it's found after retirement, they still have the option to pay that. After they've ended the employment, they have 6 months to pay that if they choose to do so. And Mr. Cheatham, just to go a little further, I'd like to add that once that member has paid and the employer is paid and the additional service credit is earned, then we will recalculate that benefit and we will pay the new benefit amount, including the additional service going forward, and we'll also pay back retroactive to their retirement date any difference between what they were paid and what they should have been paid.
And just so everybody understands, I took away from that discussion, whether we're talking about somebody that came in and retired or whether we're talking about somebody that's only got, 4, 5, 6 years in, and just, we've discovered there's, whatever block of time that's not been credited. That 6 month when clock starts ticking then for the employee to make those contributions. Is that correct?
Yes, as soon as the cost is approved and sent to the employee or member, then that's when the 6 months begins. That's when it begins.
I found that part of our discussion interesting. I wanted to make sure all the other trustees had a feel for how that worked.
Do we have any other?
Just a little
I
bit.
think Steve's got his hand up.
Oh, I'm sorry.
I'm sorry, that question elicited a follow-up, I suppose. So, maybe without getting too weedy here, generally the employer is withholding the employee's responsibility from the employee's paycheck as they run payroll. So when we talk about the employee paying their share, I mean, isn't that generally coming from the employer as well? Or are we finding situations where the employer never properly withheld the employee portion, or am I maybe getting too much in the weeds for purposes?
The scenario that we were just discussing about the omitted service was that the contributions had never been withheld. So in that case, where the employee or member has the option to pay it, they can use pre or post-tax dollars to do so, but it wouldn't come from the employer at that point. Unless it's set up on an installment purchase plan. If it's over $1,000, members can set that up and have it payroll deducted and sent to us to pay over time, not to exceed 5 years. And then one additional thing I wanted to add about omitted service is that for active employees, meaning they're employed with a participating employer and earning service credit, if they don't pay the omitted service within the 6 months, they can still purchase that later, but they would have to pay interest on the contributions that were billed. But once they retire, they only have the 6 months.
Understood. Thank you.
Yeah, Mr. Webb, just to clarify a little bit more, Aaron, typically this hasn't been withheld from the employee's paycheck when we're asking the employee to do that, yes.
Just a question I was curious about. Are these circumstances typically found here, or are they found by the employee that there has been omitted service credit being given? And how frequent is that occurring?
I don't know the frequency of the omitted. We will often, through interactions with our members, whether it be a phone call or during an appointment that we have, we'll discuss, the service credit they have and what we have on file. And sometimes it will be discovered at that point. I know that it happens at post-retirement audit when our auditors are doing the post-retirement audit of the retirement account. Occasionally it's found, but it's not frequent at all, very infrequent that we find something that's missing at that point.
Yeah, Dr. Hackbart, most of the omitted billing that you see in these top 10 employers were caught through a review of that employer or a tip that was given to us. And a lot of them are what we call part-time people that averaged. And once they've averaged, we need to go collect that year of service that they actually averaged for, and that's considered omitted billing. So I think most of the dollar amounts that we see related to omitted come through the review process that KPPA is doing currently and plans to do more of in the future.
Any other questions for Mike? Thank you, Mr. Lamb. Appreciate all that.
I don't think I'm done yet.
Oh, sorry. Keep on rolling.
Sorry, this is the admin budget through March 31, and basically I just write the comments out there. I'm not going to read all of them, but I'll read. If you just page down one page, Sherry, it'll show the comments in there. But basically, through the third quarter, we've spent 73.25% of the admin budget. We have 26.75 left to spend in the last 3 quarters. I mean, in the last 3 months or the quarter 4, I think that we're going to be under budget in most line items across the board, and definitely overall for this admin budget cycle, we're going to be under budget. So there's comments in there, and there's the detail the next few pages, but due to the length of the agenda, I will move to the last topic, which is basically in the Finance Committee. I give a draft for the fiscal year 2027 budget, and I think that begins on page 45. And we had a robust discussion about that as well. But at the end of the day, the KPPA admin budget needs to be $49.8 million because that's all we were allocated through the K-BUD biennium budget process that got passed in House Bill 500. My calculations at the time kind of show that we were about $1.4 million short. I've refined that a little bit to be 1.439 as of the date I gave this to Sherry, but still I'm only going to be able to budget $49.811 million for the admin budget. Internally, we've adjusted that $1.4 million some more, and I've then allocated it. Basically, I'm taking it out of the personnel costs, and we will budget the personnel costs as an executive team to meet the $49.8 million. And Mr. Cheatham had some good questions about, what's our projected actual for 26? And like I just said, in the admin budget, we're going to be a little bit under budget. Our budget was 50 million. We're only going to come in around 45, 46 million. And so in that third yellow column, it kind of shows the difference between the proposed 27 budget and the actual. And he had some good questions about, where is that $5 million not being spent this fiscal year versus where it's going to be spent in fiscal year 27 and 27. And you can see the biggest one's going to be in personnel. And these are high level categories. So the next page shows you the detail that make up those high level categories, and I've broken out those items in red. So that 1.49 million that I need to find, we've allocated again between salaries, which then leads to FICA and retirement contributions. We've also touched base on some other numbers, but the differences that Mr. Cheatham was asking about, I've also highlighted in red. So for example, legal costs, we budgeted 1.8 million. But actuals through May, we're only spending 700,000. We had a pretty good year related to legal costs, thank goodness. And then next year, we've also reduced that budget from 1.8 to 1.3. But when you're looking at budgeting 1.3 versus only spending 700,000, that's a $600,000 swing between actual and our next year's budget. And so I've highlighted those in red to kind of give the board members a little bit more clarification on where that number is changing and why. And you can page down to the next page and see, I think the computer software, we're budgeting 3.9 million next year. We budgeted 3.9 million in 26, but we've only spent 2.9 so far. We expect to spend 3.3 by the end of June. And so there's a $600,000 swing in what our actual will be for this fiscal year and what our projected budget is for next fiscal year. And I've just tried to highlight them to get back to that 1.4 million. But at the end of the day, we will budget for 49.8 million. That will go in front of the KPPA board at the end of this month for their approval. But I wanted to present that to the Finance Committee, get some feedback, which I did, and now it's for informational purposes for the C board to kind of see where the admin budget's going to land for KPPA. Now I think I'm done, Mr. Romero.
Well, well done, Mr. Lamb. You covered a lot and you did it well. So appreciate that. Next is Mr.
Mr.
Surratt.
Webb,
Yes, have
I'm sorry,
another
Mr.
question?
Webb has his hand raised. Yes.
I'm sorry, Steve. I can't see you from the presentation I have.
No worries, thank you. Um, What I wanted to ask, Mr. Lamb, when you are preparing the budget, when you're budgeting for the salaries and related benefits, do you assume that all positions are filled all year, or do you assume some level of vacancy?
Yes, we assume vacancy. So it's pretty complex. But I do look at our historical turnover rate for 5 years, and I budget a turnover rate in there. So for this fiscal year, we're actually budgeting all cap positions, which is 284 in our full-time cap, with a few interims and interns. But then I throw the vacancy or the turnover rate in there, and that reduces my positions by 11. And again, that's just historical. We've also looked at the costs. We have about 12 retirements happening on August 1st. And those individuals, some of them have some good benefits coming with their retirement, right? So if they have vacation time or sick time and some comp time, a lot of that gets paid out. So I've recalculated that, put that into the budget, and so the way we manage those 284 positions is, we're looking at, okay, if we do have a person that turns over, can we delay hiring that position by 1 or 2 months, et cetera? But we're planning on filling all 284 positions. Even with the turnovers, we're going to try to replace them as quickly as possible. But as a management team, we do have to manage that salary line item by about $1 million through that. I've already calculated 11 positions turning over in that number. So,
Yeah, understood. Thank you. I've been there. It's a lot harder than it sounds. So I appreciate what we have to do, but just wanted to make sure we all understood that. Thank you, sir.
Jerry, be my eyes for me. Are we all clear?
I think we're all clear.
Okay, thank you. And thank you for all the questions. They're good clarifications.
yeah, thank you.
Right, next we have hazardous duty request. And Mr. Surratt, would you walk us through that, please?
Yes, I will. Good afternoon. We have 17 positions being requested for hazardous duty coverage. All positions being requested are police and paramedic positions. KPPA has reviewed the position questionnaires and job descriptions, and these positions do meet the statutory guidelines for hazardous duty. I do want to let the board know that Anderson County Fiscal Court is requesting 2 retro dates, as my team completed a compliance review on the agency and found that they were reporting members in incorrect hazardous positions. However, KPPA was still receiving hazardous duty contributions on these members, so we didn't lose any contributions at all. The CRS Finance Committee reviewed and approved these positions to go forth in front of the board for final approval. If anyone has any questions, I'll be happy to answer them.
So move approval, Mr. Chair.
Got a motion to approve the hazardous duty request. Is there a second?
Second.
Second by Dr. Carver. Any questions or discussion? All in favor signify by saying aye.
All right.
Aye.
All opposed? Ayes have it. Hazardous duty positions as listed have been approved. Okay.
That concludes our report, Mr. Chair. Thank you very much.
Thank you, Bill. Okay, with that, we'll move on to the investment committee meeting, or excuse me, the investment committee report. Dr. Hackford.
Thank you, Mr. Chairman. The CERS Investment Committee met on May 29th. The Investment Committee heard 2 presentations, one by the investment staff and the other by Wilshire, in terms of the economy. No votes were taken, therefore we have no items for ratification by the full committee this afternoon. Wilshire led a discussion of the economy, and KPPA staff provided investment performance information for the committee. And with that introduction, I'd like to turn it over to Steve for discussion of the presentation that they made at the investment committee. Steve?
Sure. Thank you very much. Good afternoon. So while last quarter already feels like ancient history, I did want Chris, who I believe is representing Wilshire here today, is going to provide a few highlights focused on the themes that were prevalent in the first quarter that are continuing to drive markets today. So I'll turn it over to Chris first.
Thanks, Steve. If we turn to slide 54, I'll cover just a handful of slides that we have in the packet today. These are Wilshire's capital market forecasts as of March 2026. As you can see, if we were to just look at a stock and bond portfolio represented by U.S. stocks and U.S. bonds, stocks are expected over the next 10 years to be right around 5%, with core bonds returning just over 5%. Obviously, this is an indication when we look at a 60/40 portfolio, which you have a much more diversified portfolio, but that portfolio is only going to return just over 5%. Really putting the impetus on other asset classes such as private equity, private credit, real assets, where we're finding more return opportunities these days to drive that return higher to meet your discount rate. Also want to call out some of the growth and inflation factors, because inflation is a major theme that we did discuss at the investment committee, looking at some of the inflation factor exposures where stocks and bonds generally have a negative factor exposure score. Other areas such as real assets, commodities, real estate, those do have higher factor exposure scores to inflation to capture that inflation exposure in the portfolio. If we move to slide 55, one of the large themes that we're really kind of keeping a track on right now, as is everybody, is the conflict going on between U.S. Iran, specifically within the Strait of Hormuz. And you can see that top chart there really showing how the flow of cargo and tankers was going through the Strait of Hormuz at the beginning of the year, and then enter the conflict at the end of February 28th. And you can see that really put a clamp down on all passage through the strait. Some of the poly market odds of in the middle chart, the strait returning to normal by the end of April, as you would expect, was not very positive, only about a 21% chance. I looked at the poly markets today, and as of today, the chances of that returning to normal operations by the end of June are sitting at about 11%. Similarly, what are the chances of the military operations ending by the end of April and the end of June? When we looked at this kind of mid-April, obviously was not very positive for that to end by the end of April at 33%, but there was positivity that the strait would, or the military action would end by the end of June. We've been in a ceasefire now for 2 months as of today. You can argue that that 82% probably is a little bit lower today, being that we don't really know what the outcome is going to look like as of current conditions right now. If we move to the next slide, one of the big kind of key themes that we've been tracking here is how the energy focus here, with not having the oil reserves. All the countries have been driving down their oil reserves over the past couple of months, and you get this shock on energy resources, how that's impacted inflation or the market's outlook on inflation. And if you look at the top two lines, which are the 2 and 1 year inflation break-even points, you can see that markets really did price in a lot of inflation, and you can see how that drove up. But it had fallen towards the end of March, as we thought there would be an outcome in a relatively short order. But you can see that was still pricing in about 3 to 3.5% inflation over the next year or two. Whether you want to call that transitory or not, that's probably maybe a little bit of an overstatement. As we think about all the reserves that have been drawn down, the countries are going to have to replenish those reserves. There are going to be inflationary kind of trickle-on effects for a considerable amount of time here. But the key takeaway here is that over the longer term, the 5 and 10 years, you can see there hasn't been a whole lot of movement there, and we are seeing relatively consistent long-term inflationary impacts or expected impacts. And lastly, how that kind of translate into short-term interest rate movements. You can see as of the end of February, the market was really pricing in 2 to 3 interest rate cuts at the time. Now that we've gone through and we see this, through the end of March, beginning of April, you can see as that energy shock took place, we see that inflation, started creeping up again. the ability for the Fed to actually cut rates really kind of dried up in the market's outlook. And so now we're really seeing no interest rate cuts by the end of the year, even the potential for interest rate hikes, depending upon how this inflation story continues to play out. With that, I will turn it back over to Steve so that he can cover some of the performance on the portfolio.
Thank you, Chris. And Chris used the T word there. We're not supposed to use the T word anymore, but no, nothing is transitory anymore. So, Dr. Hackbart's memo provided a good summary of the material, the performance material that we covered in the investment committee. So I just wanted to hit a few of the highlights and provide an update of performance since the end of the quarter. The quarter was a tale of two halves, with risk markets producing solid returns in January and February, only to give it all back in March. Primarily as global markets navigated that volatility, which was dominated, as Chris mentioned, by the conflict in Iran, that seemingly oscillated daily between escalation and de-escalation, which whipsawed energy markets and risk markets more broadly. Disruptions to regional shipping, as he highlighted, and energy infrastructure pushed oil prices higher, with global equities reflecting a broader risk-off tone and worsening sentiment as monetary policy expectations re-rating significantly in response to higher inflation expectations. We went from projecting a cut by the end of the year in Fed funds to, I think today we're over a 40%. The expectation is about 40% probability of a rate hike by the December meeting. Artificial intelligence related disruptions remain top of mind, with software and memory stocks selling off and concerns growing about exposure in private markets, with several semi-liquid private credit funds reporting repurchase requests exceeding their 5% NAV quarterly thresholds. Consistent with that broader market backdrop, after posting positive performance in January and February, the portfolios declined in March, pushing the performance for the total quarter modestly negative. The CERS pension composite produced a return of minus 97 basis points for the quarter, which did outperform the blended benchmark's return of minus 1.38%, while the CERS insurance composite produced a return of minus 1.01%, also outperforming the return of its benchmark by 32 basis points. Individual portfolio performance for the quarter ranged from down 95 basis points to down 104 basis points, with all of the portfolios outperforming their respective benchmarks by between 29 and 41 basis points. Apologies, Sherry, we're on page 64. Thank you. During the quarter, the largest contributors to outperformance were the relative performance in the real return and specialty credit portfolios. The specialty credit portfolio produced a return of 42 basis points, which outperformed its benchmark by 94 basis points. And that was with 15 of the 17 portfolios outperforming their respective benchmark during the quarter, led by the opportunistic credit strategy that outperformed its benchmark by 240 basis points during the quarter. The real return portfolio outperformed its benchmark by over 450 basis points during the quarter, with exceptionally strong performance in the portfolio's MLP, toll road, and infrastructure strategies. The largest drivers of underperformance during the quarter was the overweight and relative performance of the public equity portfolio, which trailed its benchmark by 27 basis points. Fiscal year to date, as of the end of the quarter, the CERS pension composite produced a return of 5.47%, outperforming the blended benchmark's return by 37 basis points, while the CERS insurance composite produced a return of 5.30%, outperforming its blended benchmark return of 4.98%. Through the first three quarters of the fiscal year, the real return portfolio has produced 811 basis points of outperformance, while the specialty credit portfolio has outperformed its benchmark by 217 basis points. This positive outperformance has been partially offset by 152 basis points of underperformance in the public equity portfolio. As we discussed during the investment committee meeting, that underperformance in public equity portfolio is not unique to CERS, as active managers globally have struggled to keep pace with the performance of their indices. Turning the page from the end of the quarter, public equities reversed sharply in April, with U.S. markets up over 10% and non-U.S. markets up over 9%. The MLP index was up over 4% for the month. High yield bonds and loans were up almost 2%, while core fixed income was flat as yields rose across the curve. We are reviewing the final April performance reports, which should go out this week. The portfolios performed well in April against that market backdrop. They're indicated up between 5 and 5.5% for the month, which would bring fiscal year-to-date returns to between 10.75 and 11.25%, with continued strong performance relative to their benchmarks. Markets remained positive in May, but with a more cautious tone than we saw in April, as volatility remained high. U.S. equities were up a little over 5%, with technology stocks leading the way, and they were up over 8% for the month. Global markets were also positive, but modestly trailed their U.S. counterparts. Notably, global rates have sold off in the month, with the U.S. 10-year Treasury peaking at 4.67% and the 30-year peaking at a 19-year high of 5.18% before retracing back to trading into their trading range. May performance is very preliminary, but portfolios returned between 2 and 2.25%, which would indicate fiscal year-to-date returns of 13.5%. Page 72, please, Sherry. Thank you. I also wanted to highlight a few additional items that occurred during the quarter and since the end of the quarter. As we've discussed at previous meetings, staff continuously focus on the cost efficiency of the portfolios from an expense perspective and actively negotiate fee schedules with existing external managers. We target effective fee rates that are in the lowest quartile of our manager universe. During the quarter, staff successfully renegotiated management fees with our public high yield manager, lowering fees by 12%, saving the systems an estimated $500,000 a year in fees. Over the last year and a half, staff has also renegotiated management fees with 7 of the 14 public equity managers, resulting in annual fee savings of approximately $4.6 million. During the quarter, the majority of assets were transferred in kind to the new Oaktree Managed Public Leveraged Loan Account. Given the nature of these assets, final transfers are expected to occur by the end of June. And based on the continued attractive risk-reward profile, compelling market opportunity, and real return allocations, staff recommended an additional commitment of up to $100 million to the ITE Rail Fund to be shared among all CERS portfolios. This recommendation was approved by the investment committee and board. The IC and board also approved staff's recommendation to transfer asset management responsibilities of the MSCI ACWI ex-US public equity mandate from the Franklin Equity Group to the ClearBridge team within Franklin Templeton. This change, as highlighted at the recommendation, is expected to improve the quality of the overall international portfolio with improved performance, less risk, similar growth, and lower tracking error. An update on XDP, who the board recommended or approved for the cost efficiency services. XDP provided a draft of the service agreement on April 27th. Vicky and legal provided XDP with comments and revisions to their service agreement on May 5th. And we're waiting on XDP for the next turn of the agreement. I did have a call with Ian and Philip on the 28th to clarify the scope of services for the contract, as well as terms for their remuneration, which will be incorporated into the next turn of documents. Capital Meridian, which is the private equity investment that was approved by the board. Vicky has completed the initial review of the fund documents and provided feedback to the manager, so that's a work in progress. And she has begun work on the side letter, which will complete all of the documents necessary for the investment. I'll pause there for any questions.
Any questions of Steve or Chris?
If not, the last page I wanted to highlight was page 79, please. As we know, these are some of my favorite Wilshire charts. And while we often focus on absolute performance, which is very important, obviously, to the portfolios, I think it's also important to consider the risks the portfolios are taking to achieve that level of performance. So I would note that all of the pension and insurance portfolios have produced exceptional risk-adjusted performance over the reported 1, 3, and 5-year time periods based on Wilshire's all public plans universe, with all of the portfolios producing sharp ratios in the top 5% of Wilshire's peer universe over the 5-year period. That really demonstrates the efficiency of the performance produced by the portfolios, and we think that's an important framing for consideration when we're reviewing your portfolios. Dr. Hackbart, that's all I had. Happy to answer any questions.
Any questions? If not, thank you, Steve and Chris, for your reports. Certainly a positive outlook for the fiscal year to date, and we appreciate the detailed information and discussion of the issues that you've been dealing with during this fiscal year.
Thank you.
Concludes our reports. We do have on the agenda a report on compliance report. Basically, there was really nothing of significance to report. Its materials are in your documents. So with that, Mr. Chairman, I would say that would conclude the investment committee's report.
Okay. Thank you, Dr. Hackburn. That will move on to item 10 on the agenda, the Joint Retiree Health Plan Committee report. Dr. Carver.
Yes, thank you so much. We have one informational report to give, and I'm going to ask Connie Patty John to do that. And at the end of the report, we'll have one item to ratify.
Thank you, Dr. Carver. I appreciate that. Committee met on Wednesday, the 13th of May, and elected Keith Piercy with KRS, specifically SPRS, as the chair, and Dr. Patricia Carver, CERS representative, as vice chair. So congratulations, Dr. Carver. Humana provided presentations, which they normally do this time of year, looking at plan year performance year over year, kind of what the outlook is for the Medicare and Medicaid final notice for the bid for insurance for 2027, the gain share and performance guarantees, and then updates from the Inflation Reduction Act, which is mainly a pharmacy type initiative updates. So the main thing I got out of the 2025, and it is the big thing that's different. Maybe you're having more medical and pharmacy claims cost utilization. So you'll see on the premium plan there, it went up from 24 to 25 performance. For medical, it was 5.89% and 16.37% for the pharmacy, and that's an increase from 2024. Central Plan saw a similar thing. Their claims for medical weren't quite as maybe high, at only coming in at 0.14%, but they are going up a little, and you see the pharmacy has the same a note there about it. I wanted to say that Humana is meeting their performance guarantees, and it looks like that they're wanting to, well, I want to talk about this Inflation Reduction Act, this last little point about it in the next paragraph. I mean, not the one right below. The final Medicare notice for next year will be the 2.48% increase, meaning that Medicare's bid is going to project that is, what's going to be the impact to the plan. So they're taking that right now. They're looking at all their options. They're looking at the benefits and the costs in the contract. And they will give us the renewal for next year, the end of June, first couple of weeks of July, which is a normal time frame for that renewal. But what we asked them to do in the committee, the committee asked them to take a look at how this IRA, the Inflation Reduction Act, impacted over the years from 2023 to 2026. And this is going to go on through possibly 2029. And you'll see that quite a few of our members reached that catastrophic cost, which, let me remind you, a couple of years ago, that was $8,000 out of pocket. And it did go down to $2,100 out of pocket this past year. It was $2,000 out of pocket in 2025. So what it's showing is that most of our retirees are not paying that $2,100 out of pocket, or even the $2,000. They're paying anywhere from $900 maybe a year. That was what they're showing the average for 25 was, versus $476 right now, knowing that this is just mid-year. So looking at how the retirees are getting that is money they're not having to spend out of pocket as they had in the past, since Medicare has changed that out-of-pocket max. And this has all resulted in increase in premiums coming to the plan. And you've seen that go up last year in the renewal. This year, it looks like they proposed some things to consider if you want to look at changing. But they are also charged with collecting data so we can watch how this continues to phase in over 2026 with the medications related to the funding there and with anything you might want to consider for changes going forward, which would be looked at in February next year or May next year and brought to the September meetings. So in looking at that, that's informational, more to come on some of it. And knowing that the place we're at is we're seeing increased utilization with, and then some retirees are having a better out-of-pocket experience. They're having less claims costs. I've talked to several of them myself, and they're saying, "Oh yeah, it's just costing $8 right now. Look, it's just June." And so the drugs and the medications the rest of the year for some of those people will be zero because the max out of pocket is only 2,100. Any questions about, that's a lot of statistics, and I know they go over a lot of data in their committee meeting around the comparison of the plans every year and how the projected and cost and those kind of things are done. So it's just a broad overview of that. If you have any questions, let me know. I think Dr. Carver was going to turn it back to you if they don't right now. Oh, Mr. Cheatham has a question.
I'm just curious, when Humana reports back to you and what was it, 16 odd% increase in the pharmaceutical?
Pharmacy, that's on medications.
Do
And part of, go ahead.
Do they
Sorry.
break that increase down to how much that is, purely cost of medications going up versus
Yes.
utilization?
It is broken down that way in detail in those Plan Compass reports. They talked in general in the meeting, but we have the statistics down to, well, they look at the entire plan comprehensively and report on that every year. The CEOs are involved in some of those meetings that get to see that, and that data is available, Mr. Cheatham. So yes, they do. They show us the drugs that are let's say high cost. They'll break it out. They'll look at it, the cost of medication, then versus the number of people utilizing. And right now, the cost of medications is, as you know, nationally, it's still very high. Even I think some of the things that are going on outside of the Medicare Advantage arena, like those medications that in the president's program, those are things that are going to allow retirees to go directly to them and get without going through this type of benefit. And that's not a lot of drugs right now or medications on that list, but it is something that we just looked at briefly because the GLP-1s, the weight loss medications, they're going to get those for about $50 a month. When we know they cost a couple of hundred up to $1,000, if you're buying them without that type of support. So that's something the seniors are seeing. But yes, Humana does do that type of detail in the statistics, and if that's something we're interested in looking at a little further, we can certainly address that, Mr. Cheatham.
Yeah, I'd just be curious to see.
We have that. I'll be glad to share that with you if you would like me to send you some information, sir.
Email, I'd be curious to see how that breaks out.
Yeah, it's very interesting. The physician who actually runs is in charge of the program, let's put it that way, does a lot of time in going over the clinical because not that the diagnosis specific, but they can break it down into, what's causing it, where you're seeing the increases, and they use that data to go back and try to help people with problems they're having accessing care, or if they see needs like that, or hey, maybe it would benefit if you try one medicine versus another. There's things like that set up automatically. So there is a lot of data they provide. It is very interesting in looking at this. And we, some of these performance guarantees and the other things I talk about that we look, those are reports we get back, and it's around performance. And part of what Medicare is trying to do is make the performance under the STAR program that gives back more money to the group is to go ahead and be able to count them. Like, this person went to the hospital. Did they really get better here? Did they follow up with a doctor? And things like that is where they're going to say that hopefully is going to keep the utilization where it should be. The right time, the right place, the right member, you know, that it's not going to be something that they don't know they have the access to the benefit, or it's just a all together, they put that together and try to come up with programs and outreach and guidance in the well-being and area for the retirees. So that's kind of, they just try to put it all together, but we are seeing across the nation the drug medications. And as you know, that's a cost driver for a lot of our Kentucky employees who are on the non-Medicare plans through the Department of Employee Insurance, the state plans that are offered. That's becoming more and more of a challenge every year, providing those benefits and looking at the costs, and then the legislators looking at the budgets. So yeah, they do provide a robust data for us to look at, and it is very, well, it is used to target, like I said, you know, things that we need to try to help them on, as well as just other, I guess, you know, ways to take care of the cost, I guess, as it's coming across, you know, ways to continue to provide a benefit that's appropriate and based on, you know, affordable, the care that you provide. So
Okay.
hopefully I answered probably too much of that, but gave you more data than you needed. But there is that.
Okay. All right. Thank you, Connie.
You're welcome.
Dr. Carver?
Sorry, I couldn't find my mute. The committee also reviewed a memo regarding the need to appoint a retired member. Didn't have to be a member of KRS or CERS, but to the Kentucky Group Health Insurance Board. Mr. Larry Totten with KRS has volunteered to fill this position, and both CERS and KRS need to ratify to take it back to KPPA. So I make a motion to have Mr. Totten appointed to fill that position.
Okay.
Second.
Got a motion and a second. Any discussion? All in favor of appointing Mr. Totten to the Kentucky Health Insurance
Board.
Signify by saying aye.
Aye.
All opposed? Ayes have it. Mr. Totten has gained CRS approval.
All right, thank you. That's the end of our report.
Thank you, Dr. Carver.
Thank you.
Next item on the agenda, number 11, is the renewal of the CRS attorney contract with Eric Bronco and his firm. Ed, do you want to touch on this? I don't think there are any changes in it compared to last year, is there?
Thank you, Mr. Chair, for the opportunity to speak to it. There are no changes from what was presented to the board last year, and we're extraordinarily well served by that. Over this past year, Eric and his firm have provided extraordinary service to various committees and the board. They have been extraordinarily responsive to requests that have been made of them, and have been generally a joy to work with. I would give a very high recommendation for this board to continue our affiliation and relationship with this law firm.
I will echo that. I've been more than impressed with Eric and his people's responsiveness and willingness to really give us Class A guidance, particularly with some of the moving parts that we continue to encounter associated with the legislature and House Bill 484, and I think they've done a tremendous job since we originally contracted with them back in 2021. So with that, I'll accept a motion to renew the contract with Eric and his team.
Also,
Got a motion. Is there a second?
I'll second, Mr. Chair.
A second by Steve. Any questions or discussion? Hearing none, all in favor signify by saying aye.
Aye.
All opposed? Ayes have it. Contract is renewed with the firm of Johnson, Bronco, Brennan, and Collins. Keep adding names to that list.
We do. I added another classmate to our roster, so hopefully we'll be even more responsive this coming year.
Okay. All right. With that, we'll move on. Ed, you want to pick up on item 12, CRS?
Thank you, Mr. Chair. The securities trading policy came to light through.
Ed, we're on bylaw change.
Oh, sorry. This is the second reading for the bylaw change that would take the ad hoc employer audit committee and make it a standing committee. Per our bylaws, a bylaw change can only be made after two votes, two readings of that bylaw change. This would be the second change. Mr. Chair, during the middle of last year, it became apparent that there were some issues identified by the state auditor related to employer audits being conducted by CERS, and they asked essentially what our response to that would be, and we established at that time an ad hoc employer audit committee, which we asked Steve Webb to chair. That committee met one time. The next meeting of that committee is scheduled for later this month, but we determined that it needed to be a standing committee because the issues that would come to it are vitally important to the health of our system. So with that, the board determined at its last meeting to move forward with the standing committee of employer audit, and it is now on the agenda for its second reading.
Okay. Are there any questions with regard to the change? It simply codifies the employer audit committee as a standing committee as opposed to ad hoc. If not, I'll entertain a motion for the second reading.
I'll move, Mr. Chair.
A motion by Steve, second by JT. Any questions or discussion? Hearing none, all in favor signify by saying aye.
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 All opposed? Ayes have it. The change is now official. Now, Mr. Ed, I appreciate you wanting to jump forward, but securities trading policy.
Well, thank you, Mr. Chair, because this is something that has been outstanding for us for a period of time. The internal audit group flagged our policy for security trading policy on January 15 of 2025. And at that point, the policy correctly was listed as a CERS policy, but the enforcement of the policy really related to members of the, at that time, the investment office. So we've had a number of meetings with the compliance officer, the CFO, and the chief auditor concerning what this policy should look like. And the balance that I tried to strike here was a balance between being as least intrusive as we could be, but at the same time providing the maximum amount of coverage to not only the organization, but to the individual trustees and myself who would be covered by this policy. I'm really pleased and think that we've struck a real good position here with this policy, and I'm glad to turn it over to Carrie to allow her to walk us through it.
Thank you, Mr. Owens, and thank you to the CERS board for having me here today. The purpose of this policy is to ensure compliance with federal anti-insider trading requirements, meaning to ensure that trustees and the CEO are aware that any insider trading information that they may encounter as part of their duties as a trustee or CEO cannot be disseminated to other folks outside of the organization or within the organization. I'll hit the highlights of this policy, and this policy is presented to you today is streamlined in the sense that the trustees and the CEO are going to be undergoing an annual training session to understand their obligations as trustees and a CEO and fiduciaries that may occasionally encounter that sensitive insider investment information. And they'll also read and certify that they have understood this policy on an annual basis. But then the part that addressed the KPPA investment staff, as Mr. Owens noted, will be moved to a KPPA policy, and the investment staff will be subject to different requirements under that KPPA policy. So what you're left with is just a policy that addresses the CERS board and its CEO. And I don't want to get too into I don't want to read this to you or anything like that. I know time is precious here today, but I'm happy to discuss any parts of the policy further or answer any other questions. Otherwise, we're looking for an approval.
Carrie, I've just got a couple of quick questions.
Yes.
I read through the old policy and the new policy being proposed, and I don't know that I have any disagreements. I just want to have a little clarification. I noticed the issue of front running has been basically removed by definition or reference. That can certainly be included in trading on non-public information, but I just want to be clear that is your interpretation as well, number one.
Yes, absolutely, Mr. Cheatham. And front running is specifically folded into the definition of insider trading in that policy. And so when the policy says insider trading is prohibited, distribution of material non-public information is prohibited, that front running is included in that as well as a strictly prohibited activity.
Okay.
And that's on, you can see that on the definition of front running and insider trading on PDF page 123 of the materials.
Okay. The second is really more about what you envision, or you and Ed envision as training and certification. I know we had a conversation early on in this process, whether you all intend to try to do that training and certification in-house, or whether you've looked at using one of the service providers out there, Kaplan or Reg Ed or somebody like that, to provide that certification.
That is the very next conversation that I intend to have with Mr. Owens after this this policy is hopefully approved today or at a future meeting if the board would like more time to think about it. But I think it comes down to whether we can find a training that addresses this board's specific needs in the public, its unique posture as a public pension board. And I would look to Mr. Owens to let me know if we're able to find something that he feels satisfies that. Other alternatives include, Mr. Bronco and his team. If they want to do the training, I can do the training. We can look to the KPPA outside counsel for training. We've got several options to ensure that the board is properly educated on the topic.
Okay. Ed, you want to comment on that at all?
The only comment that I would make, Mr. Chair, is I agree with Carrie. I think that's step 2 of this process. I'd like to see first what we might be able to do internally. I think that internally we could develop something that is robust. But if that becomes challenging, then we'll look externally to see what best fits for what we're looking to do.
Okay. All right. Anybody else have questions? Mike, I see your hand up, sir.
Thank you, Mr. Chairman. I noticed that this does require annual training, concerning insider training.
Yes, sir.
This may go to Ed. I'm not sure. Perhaps Ed can respond to this. Will that be done in conjunction with other training provided to the board in one session, or will there be a separate training session devoted solely to insider trading, or do you know yet?
Don't really know yet, Mike, but the effort would be, certainly it will be a separate and distinct training. Whether that training is coupled with other training that the board has been gathered to do, that hasn't yet been determined. I think some of that will depend on how robust we make that training. It may be such that if it's a 2.5 hour training, that might be all we'll want to do in a single day. I just don't know yet until we get to that aspect of it.
Yeah, I could foresee initially maybe a longer session, Ed, because to get us our radar clearly focused on this issue, and then perhaps revisit that issue on a more limited scale going forward.
Absolutely.
Anybody else have questions? All right. At this time, I'll entertain a motion to accept the investment, how we determine this, the securities trading policy as presented.
So moved.
A motion by Dr. Carver.
Second.
Second by JT. Discussion. Anybody have further questions? Hearing none, all in favor of acceptance of the new securities trading policy signify by saying aye.
Aye.
All opposed? Ayes have it. Now, am I correct in assuming this will not need a second reading?
Correct.
Okay. All right, so this going forward will be in effect immediately then.
Well, thank you so much for your time, and I'll get this circulated for signatures.
Okay. All right, Ed.
Well,
I believe we're ready for your CEO report, sir.
Mr. Chair, as thank you. As you know, the report is in board book, and in the interest of time, I'll just open it up to any questions that anyone may have about my report. I'd be more than happy to entertain them.
I don't know that I have any questions. I certainly want to encourage, if you have not had a chance to read Ed's report, I would strongly encourage everyone to do so. And, you know, feel free to contact him or myself or whoever you think you need to discuss any of the items in it. You might, Ed, if you don't mind, at least, because I know Steve referenced it, if you want to touch on the XTP, where we are just a little bit there, though.
Certainly, and Steve gave a very good account of where we are with XTP today. Steve and I have had more than one conversation about how we move forward, and one of the issue that is front and center today is XTP had represented that they had a product where when they brought back dollars, that for the first 2 years they would receive 50% of those dollars, and that's how they presented themselves through the RFP process and what was accepted by the investment committee and ultimately the board. So when we get to the contract phase, as it turns out, because this board knows that we have very few assets that we own 100% of. In general, we may own 70% of assets. So the question became whether or not when XTP found in contract A $100, whether they would get $50, which would be half, which is what they believe they were contracting for, or whether they would get half of the $70 that was attributed to C, which would only be $35, because C ostensibly would have no ability to ensure that the other system would be willing to pay, because heretofore they've not evidenced any intent to be involved here. So my recommendation to the board, and I had mentioned to Steve that this would be the recommendation, that ultimately C agree that irrespective of the percent of the contract owned by C, that if XTP was able to bring back $100, that they would get $50. So that would mean of the $70, if we own 70% of it, we would only then receive, at first blush, $20. So we would pay the entire 50%, even though $30 may go to another system and they didn't pay into it. That's not an issue that XTP should have to ferret its way through. And again, it's not the way they presented their product. So, and I really believe, Mr. Chair, that it comes down to how we look at this exercise. Whether we look at this exercise as a money-making opportunity for C, and everyone will be grateful and thankful that we get, if we find extra dollars that come back to C, everyone will be grateful for that. But do we look at it as a money-making opportunity for C or a risk mitigation strategy? I would encourage the board to look at this as a risk mitigation strategy, because as we've seen some media reports very recently, that there are people out and about who are trying to get into public pension plans, saying that you haven't done forensic audits and that sort of thing. So we should want to take that off the table provide the forensic audit, and then maybe at a later date have a conversation with our brethren at K about what the equitable thing to do would be on the money that came back into our system. But to delay our ability to start this process when the most important aspect of this process is risk mitigation, I think would be detrimental to us and not serve our interest.
And couldn't we just have our relationship with them on the 70% that we have? In other words, any other findings are irrelevant to us as far as we're concerned. We're concerned about the 70% that we have invested with that entity, and that our relationship with them would apply to the 70% where we'd split that.
Right, and that would be the case, Dr. Hackbart, but if they found $100 worth of savings, $100 worth of savings would come back to the system. So even though only 70% of it is represented to us, they're dealing at the manager level, so $100 would come back to the system, just not all of it would come back to us.
Do we care about that?
And I would say that because I would view this not as a money-making opportunity, I would say that we shouldn't care about it.
Right.
That we should burden the entire weight of the 50% that we contracted with XTP to provide to them and utilize this as a risk mitigation strategy, which it is much more significantly than it is an opportunity to recoup funds into the system.
I guess my point, though, is that, okay, of the 70%, we would get $35 of those. If we just had that relationship only focused on our 70%. If we go the way that you had suggested, we only get $20. That doesn't seem appropriate.
Yes, well, but $100 is going to come back to the system.
Right.
Because that's what they found. Mm-hmm. And we and via contract, we would owe them $50. So $50 is coming back to the system. So, and the question then becomes, where does that $50 go? Of the $50 that comes back, if we don't get any help in paying that $50 that went to XTP, then the 50 would have to come from us. I don't think that we could ask XTP to say, well, we know that you presented that you would engage in this exercise with us for a 50% return, but we want $100 to come back to the system, but we're only willing to give you 35 and not 50.
Bill, you got your hand up, sir?
Yes, thank you. I have 2 points I'd like to make. One is we sent out an RFP that said what we were looking for, and it was for the C system. So I don't see where we have an obligation to meet the request of the vendor. I think the vendor is responsible to meet the request of the person who sent out the RFP. So I'm like Dr. Hackbart, if we agreed to look at a 50-50 split, then it's 50 on our savings. And it's not between us and XTP for the difference. So I don't see where it's our responsibility to pay that extra $15 in the $100 example. The other point I wanted to make is that we had two offers back from our RFP, and we approved XTP based on negotiations, and those negotiations were at 50%. If we can't come to an agreement with that, we have a second vendor that we could look to see if we wanted to negotiate with. So I don't see where it is incumbent on us to address XTP's concern. So,
Mr. Chair, if I might respond to that. Bill, you're absolutely right. You could say that you either take the 35 or we'll do something else. We certainly have the ability to do that, but it would not change the fact that the system would reap $100 back. There is no way, because we have investments that we don't own outright, that we own with other systems. So there is no way to say to a manager, only give us 70% of the return. I mean, I guess you could say that, but I don't know in how you would execute against that or why that would make any sense. So $100, however you choose to deal with XTP, $100 is coming back to the system. And I just think that it would make sense, and we would be fair to deal with the vendor in the way that we originally agreed to deal with him, though, again, this board can choose to not go down this road at all. I think that would be a horrendous mistake for a lot of reasons, but you could choose to do that.
Well, couldn't this third party, couldn't they actually negotiate with the other parties involved? I mean, in fact, we have our agreement. Otherwise, they're a free rider, and it doesn't seem why we should be subsidizing other investors and taking and basically reducing our return as a result of that. It just doesn't seem fair.
Well, that doesn't seem fair, but I would say that it's in the same category as it wouldn't seem fair to have XTP settle for 35. So I agree with both of those statements, but we wouldn't necessarily, we wouldn't necessarily have to allow that free ride to continue forever. We could go to the other system and say, hey, you just got $30 back. We had to pay $15 for that. Could you please give us $15? I mean, we could do that.
They probably wouldn't.
Mr. Owens?
Yes.
For clarification, I just wanted to let the rest of the board know that when Vicki Hale in our legal office here was redlining and negotiating this contract, the first turn of this contract when we sent it back, we did that and put XTP on notice basically when we created the red lines back, that it was only on the CERS portion of the assets. And we did that with an intent to try to make sure, to some of the comments that Dr. Hackbard and Mr. O'Mara have brought up, that the CERS's assets were only being used to pay for CERS's savings. So I just wanted the rest of the board to know that when this came up, that's where this maybe originated with XTP and kind of got to this point. I wanted them to understand that we did that trying to ensure that protection for CERS's assets.
Oh,
so
yeah.
I wanted that out there to know we did that in that attempt on behalf of CERS, because we viewed this as though only CERS has approved the contract with XTP.
Yes.
And we wanted to negotiate it from that perspective.
Right.
So,
but again, Michael, I'll say to you, there's no way to keep $100 from coming back to the system once it's identified.
And I don't want to speak into the board's decision.
Right. The question then becomes just where does that $100 go? And we don't have any legal right to more than 70% of it in that example. So only 70% of it could come to us. But $100 is going to come back to the system because there's no, I'm not sure there's a way, and maybe there is, that XTP could go to the manager and say, hey, we found that the calculation should have been done this way, and the manager agreed, and the manager say, well, but XTP then say, but only give us 70% of that revised calculation. I don't know how you would execute that.
I don't think our situation is unique. My guess is they've had a similar issue arise in other relationships that they have established already. I wonder how they have dealt with those.
There's a couple of things there that I'll just like to clarify.
Funds.
Yeah, there's a couple of things there I'd like to clarify. Number one, let's don't lose sight of it. It'll be up to the investment committee / board when they come back with a report, with, let's just say 10 different money managers on there, as to which ones we pursue and which ones we don't pursue. But the larger issue, and I think this goes to part of what Dr. Hackbert may have just alluded to, I don't know whether this is a unique situation or not a unique situation, but this is the kind of problem that we get into when we have commingled assets. And that's a much larger issue that needs to be addressed. And I think we even brought that up, and I'm not sure where it stands. Vicki or somebody can probably address where we are with the RFP for custodial services. But in earlier conversations with at least BY Mellon, that they really don't have any kind of problem separating those ownership issues out. I think that's something that both the investment committee and the board is going to have to look at and address in the near term, is just the ownership of these issues or these assets going forward. We've got the outstanding issue of the assets, the insurance assets not being held even in CRS's name. I still can, feel like we've got an issue with the fact that all these assets, by and large, are being held in a defunct entity's name and not in either, K or C's name. So I just want to, put that one on the table for clarification as well, going forward. Bill, you got your hand up again, sir? You're on mute, sir.
But I made a really good point when I was on mute, so I'll try to remember what it was. I'm just playing point counterpoint, so if I could, first of all, risk that word, reducing risk. This isn't a yes, no. We have another vendor who will do it for a fee, and that will address the risk factor. And again, I don't know how our fiduciary responsibility is to agree to a 50% split and then go to 66. If we say, okay, amend the contract and say we're going to pay 66% of it, of the fee, and make them whole so that they get 100%. And everybody's comfortable with paying 66 or 67% instead of 50, I think that's a conversation that would need to be rehashed. But I don't think we should say, if we don't take this contract, that our risk factor is wide open. I think the review is legitimate and that we have options to that. I also don't know about the C paying fees for the benefit of K. I don't know the legalities amongst that, but I think it would be something that would have to be thoroughly vetted before we embrace this discussion at paying a 66% fee instead of a 50% fee. It's just brought a lot of questions to mind. I understand the paying and then benefiting down the road. But I also remind everybody that first 2 years we're writing checks. So we're paying a fee based on future savings versus here's the known cost and we just pay it and then benefit immediately from whatever the fees bring forward. So different ways of looking at it, but I just wanted to put those out there.
Yeah.
Bill, I just point of clarification.
Yes.
There are no checks written until savings are earned.
Correct.
You know, there's no payment, you know, until we realize savings, there's no money exchanging hands. Tom, you got your hand up, sir?
Yes, sir. Is there not a way that we can just invoice the case system for their percentage of what we get in return?
Yeah, short of an agreement, I don't know. I think personally, you know, I'm going to go back to what I said earlier. You know, maybe this process needs to be coupled with the separation of assets in order to ensure our savings and our ownership. Steve?
Thank you, Mr. Chair. I might just point out with respect to this issue that we pay 2/3 of all the administrative expenses based on our head count. And so if there's an issue with paying more than 50% here, perhaps we need to revisit that as well.
Okay. Well, there's nothing for us to decide or deal with at this point. I just wanted to have a discussion so that everybody was clear and aware of the points that we're trying to get negotiated out and worked out. I appreciate Ed being forthcoming and putting it in his report so that everybody had it in front of him. I would encourage you to take time to reach out to him and get a better feel for where we are and what the possibilities are and how we can deal with it.
What's the current status of the negotiations, and is this an open question with the contractor?
I believe so, yes. So we are waiting, as Steve mentioned, we made our turn of the initial contract they sent us. Vicky made the red lines and sent it back to them, and we are waiting for their turn back to us.
Maybe they'll have a solution that's fair.
Yes. So let's see what they send back, and then I would suggest, you know, the next step would probably be for Dr. Hackbert and Ed and I to, you know, have a conversation with XTP and on whatever the options are at that point.
If I could, Mr. Chair, one more comment. You're absolutely right about the assets. We certainly need to have assets in the name of CERS. This would not be an issue if that were the case. And there has not been a single question raised here today, and all the questions around this issue have been very good and very legitimate questions. But there's not been one that we haven't had conversations with our legal counsel about how we could move forward given very different scenarios. So this is a fluid process that is being addressed the best way that we can address it under the circumstance that we find ourselves in, but to simultaneously move forward with having our custodial bank do whatever it took, and that will include expense to separate assets so that this would never be an issue again, to me makes a lot of sense.
Okay. Well, let's move on. This is certainly not an issue we're going to solve today. Ryan, I assume you're in the boardroom somewhere.
Mr. Chair, Ryan sends
KPPA.
apologies. He had to be out unexpectedly this afternoon.
Oh, okay. I'm sorry.
That's okay. I can present his memo with your permission.
Sure.
Okay.
Yep.
I'll try to be quick and highlight some of the things. We wanted to let you know that the Team Kentucky Internship Program, coordinated by the Personnel Cabinet, we have, as we've mentioned before, 5 interns in the area of legal advocacy, executive, IT, investments, and accounting. Those 5 individuals are hard at work, here and hard at work. The KPP Management Essentials, this is a new leadership initiative that we have created. It's called Leadership as a Superpower, and we have 10 managers who are participating in this program. We had 2 employees participate in the Governor's Leadership Program for Emerging Leaders. The program began in August of 25, and the participants graduated in May of 2026. We also had 2 employees participating in the Governor's Leadership Program for Executive Leaders. That also began in August 2025 and is scheduled to wrap up in the next couple of months. Mike Lamb and Ryan presented at the CERS annual conference and exhibition. During the learning portion of the conference, they presented on staying the course when it's hard, lessons in pension funding discipline. And I know that there were attendees from different pension plans across the United States in attendance there. Strategic planning, we've been hard at work at the 2027 business plan, and we will be presenting that to the KPPA board for approval at the meeting at the end of the month. We wanted to remind trustees that we are planning for the 2nd Trustee Impact Forum. Please save the dates for October 22nd and 23rd. More information will be provided on that later. The legislative update, Ryan and I presented at both the PPOB and the Interim Joint Committee Budget Review Subcommittee on General Government Finance, Personnel, and Public Retirement. We presented reemployment after retirement presentation. The Louisville office, we're excited to report that the construction piece of the project has officially begun, and I found out just before I came into this meeting that it is actually ahead of schedule. So I was glad to hear that, but we will probably take occupancy in the fall. And there are several kudos on here that I'm not going to read all of them, but like to say that Kristen Coffey and Madeline Evans led an engaging lunch and learn on understanding the internal audit process. That was a very nice presentation. We'll also point out that Stephanie Herod and Alice Ashburn had some recognition from our members on outstanding customer service. And then also Joe Gilbert, he recently renegotiated some fee agreements, which resulted in over $4 million in annualized savings across the pension and insurance funds. So with that, sir, that's all I have. I'm willing to take any questions anyone may have.
Aaron?
Yes, sir.
I didn't hear it on there, but seeing it on my screen reminded me we are apparently going to be changing sometime by the end of this month from board books over to this on board. You want it, or somebody else here want to touch on that and let us know if there's going to be some type of training or whatever in order to make that switch on our part?
Sure, I can let Sherry give a little more information, but that's correct. We are switching our platform for our board materials that we use for our board and committee meetings to Onboard, and is the new platform. And Sherry, I know, Sherry and Mary both, I think, have sent out some information regarding the transition to the new platform. But Sherry, do you want to provide just a little bit more information on that?
Sure. So we are changing our board book platform to a company called Onboard. Mary has been working very hard in trying to get everything up and running on that platform. If you have not already signed up, we've had some trustees who have already signed up. I would just encourage you to go to your KPPA email address. You should have, an email there from Mary that will instruct you on how to sign up with links to get you right to where you need. If you have any questions, feel free to reach out to myself or Mary, and we can walk you through that. And that's all I think I would have, unless anybody has any questions.
Anybody have questions with regard to this change? Okay. All right. Ed, Michael, Eric, do we need to have a closed session?
Yes.
Yes.
Okay. All right. With that, I'll accept a motion to go into executive session in order to discuss legal issues pursuant to KRS 61.810C. Is there a motion to go into executive session?
So moved.
Second.
That's second. All in favor signify by saying aye. All opposed? Ayes have it. A motion having been made in open session to move into a closed session for specific purpose, and such motion having carried by majority vote in open public session, the board shall now enter closed session to discuss pending litigation pursuant to KRS 61.810C. Phil, can you